Okay, let's dive into this. Welcome to today's explainer. We are looking at a really profound underlying shift happening right now across the digital asset space. It's May 17, 2026, and the cryptocurrency market is officially shedding that old Wild West reputation and stepping into a fascinating new era. Right now, we're witnessing the real-time installation of, well, institutional-grade plumbing and heavy-duty risk management. So today, we're going to connect some seemingly unconnected news stories to show you exactly how this market is maturing, literally right before our eyes. Here's the roadmap for where we're headed. First, we'll unpack the institutional risk calibration. Then, we'll expose some cross-chain vulnerabilities, see how regulators are actually building the plumbing, look at DeFi security upgrades, and finally, explore the kickoff of the utility phase. So, Part 1, the institutional risk calibration. Let's set the baseline for what's actually happening out there right now. The crucial point we have to start with is this number. Bitcoin is maintaining just remarkable stability, turning that mid to high $70,000 range into what looks like a permanent floor. Even with massive macroeconomic pressure swirling around, the asset is finding a true market mean right around that $78,000 mark. But, this calm surface, it's definitely masking some incredibly heavy construction going on underneath. Which brings us to Part 2, cross-chain vulnerabilities exposed. Because despite that beautiful price stability, there are still massive systemic risks lurking in the shadows. Just wrap your head around this staggering number for a second. 1 billion. We just got a major security alert because an attacker managed to mint over 1 billion fake DOT tokens on the Ethereum network. Crazy, right? This happened entirely because of a critical proof replay bug in the Polkadot Hyperbridge. Cross-chain bridge architecture is still a primary systemic risk, and developers are scrambling to patch this. It sounds like an absolute market-destroying catastrophe. But the outcome was actually really weird. On this brilliantly illustrates a fascinating dynamic: scale contrast. The attacker minted $1 billion worth of fake tokens, yeah, but they could only manage to cash out around $240,000. Why? Simply because the liquidity pools were too shallow. There literally wasn't enough real money in the automated market maker pools to absorb all those fake tokens. So, in this bizarre twist of fate, the lack of liquidity actually acted as a natural defense mechanism. It literally saved the market from a $1 billion collapse. Meanwhile, in the physical world, the walls are definitely closing in on bad actors. Brazilian police just wrapped up a sweeping operation, arresting several high-profile singers linked to a massive $320 million crypto laundering ring. So while crime absolutely still happens, the plumbing of international tracking is catching up fast. Exchanges are working directly with law enforcement, and regional on-chain tracking has gotten incredibly sophisticated. The Wild West days are definitely numbered. And that sets us up perfectly for Part 3, regulators build the plumbing. Global authorities are officially stepping up to the plate. Take South Korea, for example. The Bank of Korea is officially pushing for the implementation of crypto circuit breakers. If you trade traditional stocks, you know what these are. It's essentially a structured pause button that kicks in during extreme volatility to prevent those terrifying flash crash style breakdowns. The big takeaway here is the mindset shift. Authorities are moving away from purely enforcement-only tactics and are finally building the protective structural frameworks needed for a mature, trillion-dollar asset class. Now, what's really interesting here is how we're seeing a similar structural shift in the United States. A new SEC staff statement just proposed a permanent overhaul of broker rules to better reflect modern crypto realities. Instead of forcing full broker registration on everyone across the board, the SEC is proposing a narrow path for certain self-custodial and wallet-linked trading interfaces to operate without it. It's a neutral but highly significant signal that the agency might be softening its stance toward decentralized front ends, which gives compliant developers a much clearer roadmap to follow. Moving to Part 4, upgrading DeFi security protocols, because it's definitely not just governments doing the heavy lifting right now. Following that recent, highly publicized exploit on the Drift protocol, the Solana Foundation has officially launched the Stride security program. This is a massive internal upgrade. It arms DeFi protocols with enhanced security audits and real-time monitoring tools. But the real game changer? It's specifically designed to defend against machine-speed AI exploits. As AI agents get better and faster at hunting for smart contract flaws, networks absolutely need these automated, real-time defenses to patch risks before human developers even realize there's a problem. Which brings us to our final section, the utility phase begins. All this foundational work is leading somewhere very specific. So I want to pose this directly to you. Is the utility phase finally here? I mean, what actually happens once this foundational plumbing is totally secure and the market can stop playing defense and start focusing on everyday use? Let's see how this builds with a pretty bold prediction from Grayscale. They just released a report forecasting that Elon Musk's X, formerly Twitter, is gearing up to use crypto to power its next wave of financial ecosystems. Analysts basically think X is laying the groundwork to become a full-service, crypto-native bank. And they've got the data to back that up. X recently launched smart cash tags for assets like Bitcoin, Ethereum, XRP, and Dogecoin, and right out of the gate, it drove an estimated $1 billion in global trading volume. That is massive, real-world utility, and it's providing a much-needed psychological counterweight to some other industry struggles. For instance, mining giant Mara just announced a 15% workforce reduction. They're streamlining operations, pivoting away from pure-play Bitcoin mining, and moving toward AI data center infrastructure just to maintain their margins. But while the miners are busy calibrating their own risks, seeing crypto successfully integrated into a sprawling social financial stack like X proves that the utility phase of this bull run is already well underway. Which leaves us with this final provocative thought. As Bitcoin turns that $78,500 level into an undeniable permanent floor, where exactly does the institutional money flow next? If heavy-duty security programs like Stride can successfully restore trust in Solana's DeFi ecosystem, are we about to see a massive rotation of capital away from range-bound Bitcoin and straight into high-performance Layer 1 networks? Keep your eyes on the data, folks, because as this institutional risk calibration fully sets in, the market looks perfectly positioned for a late May push toward $85,000. Thank you so much for joining me for this explainer, and keep learning.